both. John, I'll start with you for your immediate reaction to that jobs number.
Well, in the note I mentioned earlier today to you folks, Wilfred, I certainly agree with Mike's assessment. You're taking the 50 basis points off, the 25 basis points, probably because the Fed is focused on inflation. But the reaction in the dollar, the reaction in the 2-year and 10-year, all reflect that the market is taking off those the expectations of the Fed easing policy going forward. And, you know, particularly picking up on Germany, with the Chinese slowdown, independent of the trade issue, you can see where the German economy continues to weaken. But good housing numbers should be coming forward. Autos should be good. Consumer discretionary should be pretty solid. Labor force participation rate and more jobs, that's a good combination for those sectors.
But, John, are multiple rate cuts now less likely this year?
Oh, I think so. I think what you'll also see is that third rate cut this year is probably off the table as well. So July, I still think they'll do it in July. We're going to see what the September numbers look like. But 2 rate cuts are reasonable. Certainly July is, I think, a done deal. But 3, I think, is off the table. And again, that's pretty consistent with Mike's assessment that 50 basis points in July is off.
Alan, what's your assessment and what does it mean for equity markets?
I think good news is good news. Good news is not bad news, as I think you mentioned earlier. In so much as I think the market has to think of this as a mini cycle of Fed easing rather than a maxi cycle where we suddenly drive rates down to 0. And what we've seen in the past in 1995 and 1998 is when you have these mini cycles of Fed easing, it rejuvenates the economy and it tends to be supportive for equities. I think we're going to be in that space for a while unless proven otherwise, unless the economy looks a lot weaker than we've just seen.
Now, we know the Fed has a dual mandate, right? Jobs, inflation, but we also know, based on some of the commentary we've gotten from Fed officials, that they're very closely watching the global picture, trade dynamics. How much of that factors in, especially when you do see weak numbers out of places like Germany?
Yeah, I think the Fed has mentioned global factors consistently, and the global economy has not looked good, and it hasn't looked good anywhere, really. All the major economies are slowing materially. That being said, it's tended to concentrate very heavily in the manufacturing sector, and it's tended to concentrate, I think, to some extent on the investment goods side of things. So I think what you're seeing here in the U.S. as well is that the capital investment side, business equipment investment, is going to be soft, consistent with the global economy. So the key is really going to be, does the consumer hold up? And so far, the consumer is holding up. But that's the one we're going to be watching.
Alan, you mentioned those episodes in 95 and 98 when you did get these mini easing cycles. Not very long after the easing in those 2 periods, people started to become concerned the financial markets got overexcited and it's sort of disengaged from the underlying economy. Right or wrong, that was the narrative in 96 and then, of course, 1999. Are we headed for something like that? You're already starting to see people say, look, the bull case is a little bit of a melt-up scenario when we have rates cut if we do in July.
Yeah, I think we have to think about that. I mean, I think we're some way away from that, but if you put another 10% onto equities and, you're having the Fed effectively easing now with equities at all-time highs, that's an extraordinary phenomena. I think if we took away the inflation story from this, you would really have to say, why is the Fed easing? So it does work in that direction of financial excesses. I think they're going to have to be careful on that one, but I don't think we're there yet.
John, what happens if the Fed doesn't cut rates this year? Because there are some folks out there who believe that may not happen. Yeah.
Well, I think the market will be really upset in terms of valuations. I think people will be asking, why aren't they cutting? What is going on here? Because it doesn't appear that the overall economy is picking up. And Morgan, I would pick up on one of your earlier segments today on CNBC. There was a lot of discussion about earnings growth slowing down. And that, again, is a tough combination. If you've got the overall economy slowing down a little, but earnings growth slowing down a lot, Fed doesn't cut, I think the market valuations are going to be really under pressure.
So, John, you're expecting a rate cut or 2 in the year ahead, but do you expect the dollar to firm up as it is doing today because it's not cutting as much as others might be?
You got it. The dollar is a relative price between imports and exports and capital flows, and to the extent that we see weaker German data and more likely a long-term ECB easing, negative rates, That's positive to the dollar, but I'll go back again to say the dollar strength means that our import prices will be lower, and that'll pressure the Fed to look at, we're not getting our 2% inflation. Inflation's not up to target. We need to ease, again, in part because dollar strength means lower import prices.
And going back to one of your earlier points that you think good news means good news to the equity markets, would you admit, though, that that hasn't really been the case for the first half of the year, that if we hadn't got that Fed pivot, that markets wouldn't be as strong as they have been? Yeah,
they've needed the Fed. I think particularly at the start of the year, we needed the Fed to pivot. So you could say that the easing that's kind of got baked in was needed to keep the equity market as buoyant as it is. I would say this, the bond market has taken a lot of the leadership on the move on the interest rate side and been very, very supportive for the equity market. So as long as that holds together, I think the equity market will hold together as well.